Hey, welcome back to The Dive. Today we're chatting with Chris Mancini from Gabelli Gold Fund. But before we get into it, if you could do me a quick favor and like this video and subscribe to our channel, that'd be amazing. Hey, Christopher, welcome to The Dive.
Thanks, Cassandra. Happy to be here.
Yeah, thanks for joining us. Okay, so we're starting to see signs that inflation may come in hotter than anticipated. How are you forecasting inflation and interest rates as the economy comes back online, given all the monetary easing over the last 15 months?
Yeah, this morning we saw a very hot, like you say, inflation print. And I think what that's showing you is that there's a lot of pent up demand. A lot of people, obviously, as we know, were stuck inside for the last year. And the other thing is that like you said, there's been all this economic stimulus. So because there's been all this economic stimulus, because the government has sent checks to lots of people, there's lots of other types of stimulus out there, these enhanced unemployment benefits, people are now ready to spend. And they're spending, obviously, more than they were last year. And that's showing in inflation. There's a lot more demand for goods. And so I expect to see inflation to continue to tick up. I mean, we're really seeing, again, there's demand for commodities. The price of copper, for example, lumber, steel have all gone up, and that finds its way into consumer products like washing machines and air conditioners. So even the price of oil's gone up. That affects resin prices, things like diapers. So we're seeing consumer prices increase, and we're seeing a tight labor market, and we're seeing demand increase. So it's likely that we're going to see inflation continue to rise. And I think from an interest rate perspective, the Fed has said that they're going to stay on hold. And so if they want to continue with their, with their credibility, and they want to be able to kind of jawbone rates in the future, I think they're going to have to stay on hold for a while. So I think we're going to see real, I think we're going to see real inflation run high, and I think that that the Fed's willing to see the economy kind of run hot and inflation run at above normal levels for at least a few months here.
So what are the metrics you're watching to evaluate the gold market at this stage?
I mean, at the beginning of the year, end of last year, what I was saying was that the kind of bear case for gold was a Goldilocks type of economy, meaning that the economy didn't run too hot, didn't run too cold, but ran just right. And if the economy was, ran a little bit too cold, then the Fed and the federal government would stimulate more, and that would cause gold to go up as people would start anticipating inflation down the road. And if it ran too hot, then that would be good for gold also, because we'd actually see the inflation, and the Goldilocks right in the middle would be the bear case for gold. And I think what we're seeing now is that too hot scenario, like I just mentioned, in terms of inflation kicking in. And so if we continue to see inflation tick up from here, so, I think, so this morning, 5% year over year CPI inflation, if we see that tick up to 5.5% next month, 6%, I think that'll be a bullish scenario for gold. And I think that'll drive the gold price higher as investors and savers look for a hedge.
There's a lot of talk about Bitcoin and the crypto market. Do you think this affects the overall sentiment towards gold? And how important do you think sentiment is at this stage?
Well, I think that the Bitcoin scenario is affecting gold on the margin, or has affected gold on the margin. But what we saw with the Bitcoin price was that it went up in such a dramatic fashion over the past year or so that there was obviously just tons of speculation in Bitcoin. So it, to the degree that there were speculators in gold, maybe like last year in August, when the gold price peaked to 2,100, maybe those speculators got out of gold and into Bitcoin. But I don't think it's speculation really. That's pure speculation, like the same thing that's driving these meme stocks. I don't think that's what's really going to drive gold at the end of the day. I think that was what was driving Bitcoin? Was this just pure speculation? So I think that the Bitcoin situation, again, on the margin, might have been affecting the gold price, but I don't think it was really acting as a real substitute for gold for people who really wanted to save and kind of hedge against that eventual inflation and currency debasement.
We assume you're talking with other institutional fund managers and large investors. How are the conversations starting to change towards large producers as we see gold sustain its price above $1,800? We would assume some of the large producers are going to catch the eye of value investors who don't normally look at gold.
Yeah, that's an interesting question, and I understand where you're coming from there. Relative to you would assume that that value investors or generalist investors might be interested in gold mining companies now, the big producers, given that they are generating free cash flow, paying dividends, and in some circumstances growing. But I'm not seeing interest amongst other investors that I talk to for gold miners yet. I think that the big picture is in the United States, if you're benchmarked to the S&P 500, there's only one gold mining company there, that's Newmont, and it's not a big proportion of the S&P. If you're benchmarked to other kind of mid cap, small cap indices, there are no gold mining companies in there. So, or depends on which one, but again, very, very, very small percentage. So, their investors really now would be U.S. investors feel like they're going out on a limb in buying gold, and I think that what we're going to need to see for them to get interested in the producing gold miners is a move in gold back above the last high of 2,100 and this fear of missing out. And, so that's good and bad. I mean, I think what it tells you is that there's really not much in the valuation of gold miners now for that potential eventuality. But if and when we do get there, it is like a coiled spring. And once others start getting involved, or once, say, one gets involved and others want to follow, there's so much money in the US that could be going towards gold mining companies. Again, if and when that kind of fear of missing out starts to make its way into the market.
Okay, so let's talk about the Gabelli Gold Fund. Can you give us some insights into the decision-making framework when investing in a gold producer?
Sure. So I'm an analyst for, and I help manage the Gabelli Gold Fund. It's around a $400 million open-end fund, which you could buy, retail investors could buy and do own, obviously. They could buy in the brokerage accounts. And so what do? So we invest in companies that we feel have the best managements, the best assets, and are trading at reasonable valuations. So what does that mean? So the best managements. So the concept there is to find managements that are able to get the gold out of the ground at the lowest cost possible, and then also allocate the capital that they get from getting that gold out of the ground in a way in which it accretes the net asset value for shareholders. And the next question, so that's the concept for the management, is we want to see that they've been able to, again, accrete net asset value for their shareholders. And one way to do that is to find a really good asset, and then through exploration, so really good deposit, and then exploit that asset, exploit that deposit, meaning to actually get the gold out of the ground. And so what do we look for then in terms of their finding good asset, or what constitutes a good asset? And a good asset is, to make it simple, I've said in the past, and it's to varying degrees of kind of laughter from peers and whatnot, but I call it the three G's, and that's, we look for a deposit that has grade, geometry, and geography. So the grade is the amount of mineralization in the rock per ton of rock. So we want high grade. The geometry is how it sits in the ground. How easy is it for this to actually extract the gold from the ground from a geometrical perspective? Like a flat sheet on the surface would be great, but that doesn't really exist. And then the third is the geography. Obviously, where is it in the world? Is it a jurisdiction that's favorable to mining, but also is it near infrastructure? So something like a good deposit in Val d'Or, for example, would be, or Timmins would be ideal.
Okay, so our audience is generally small cap focused. What kind of junior gold companies do you think offer the most attractive risk reward profiles at this stage of the gold market?
I'll mention a couple Canadian ones that we have. I mean, one that I like a lot is Wesdome, and Wesdome has two mines, one in Northern Ontario, one in Val d'Or, as I just mentioned. The one in Val d'Or is called Kena, and it was put on care and maintenance, meaning they didn't mine there. They haven't mining there since I think it was 2016 is when they put it on, or actually maybe 2013, I think they put it on care and maintenance. And in 2016, they drilled beneath their old mine. And they found a really high grade deposit, and they've delineated that. And now recently, just a couple months ago, they found more gold just right near that other high grade deposit. So there's a very good chance that I think there's a very good chance that they're going to find a lot more gold down there in the Kena mine, which is, I think, Val d'Or, one of the best jurisdictions in the world to mine. The other ones that I like are ones that are just broadly, I like the concept of buying small cap companies now, even like kind of micro cap. For us, we can't get too big enough, but there is a good risk reward in micro caps that aren't in indices, that aren't in the GDX, which is just blind, mindless investment. Sorry, GDXJ, blind, mindless junior mining investing. And so if you can buy like a micro cap, so for example, another one that I like that we own a small position in Val d'Or is called Probe Metals. They have a deposit, a couple deposits, Eastern Val d'Or. It's not in the indices. They're finding more gold. They're well financed. So like from a downside perspective, you're not going to feel all the volatility of the gold price. But if the gold price really runs, investors will start to look for something in a good jurisdiction. So in a good jurisdiction with the potential to find more gold, and with a lot of gold. So like Probe Metals, Troilus is another one in Quebec. Moneta Porcupine is one in Timmins. So these are the kind of ones that we have small positions in that we think have good risk reward skews.
Okay, Chris, last question here. So not everyone will give us a target, but where are you forecasting the price of gold at the end of the year?
Right. So the targets, what I would say is that I think, like I said, inflation will continue to run hot. And therefore, I think that the gold price will be higher. The question is, what does the Fed do? Like, how does the Fed, I think it was your second quarter, I think it was your first question, actually, right? How does the Fed respond to the inflation running hot relative to interest rates? I think that they're going to that they're going to keep rates low. And so I think gold will run. I think gold will be higher at the end of the year than it is now. So it's 1,900 now. I think maybe it'll be 2,000, 2,100. But the wild card there is, what does the Fed do if the Fed does start to raise rates? Does that spook the market, and does that spook gold for a short period of time?
Mm-hmm. Okay, well, that's all for today. Thanks so much for joining us.
Thanks, Cassandra. Thanks for having me.
Thanks so much for tuning in. I'll be back tomorrow, so don't forget to hit that notification bell.